Hey guys, it's Dave. We're going to do a real estate roundup for you. I've got three things to discuss in this video. Number one, we're going to talk about home builder sentiment, new home construction, and just kind of some information that's been released in the last week around that. We're going to talk about interest rates, not only mortgages, but the federal interest rates from the FOMC committee. They have been talking over the last week and changing what Wall Street believes the outlook is for future rate increases. And then we're going to talk about office vacancy rates. I came across some information that I find very interesting about the vacancy rates in cities across the US. So let's first start with the Wells Fargo National Home Builders Association market index. This is a sentiment reading that is between 0 and 100. 100 being completely, totally optimistic about the future and 0 being negative. So a reading of 50 is neutral, and that's actually what it came in at for the month of May, which means they're basically flat even if you surveyed them about their outlook, positive or negative. But it is the first time that it wasn't negative since August of last year. You can see we had some, really nice runs over 2021 and started declining late 2022, got very negative over the winter, and now we're climbing our way back up. There is an average of about an annualized rate of 683,000 new homes sold. That's the current pace of new construction homes sold. And you can see kind of by the chart, that's pretty average going back to 2018. We had some peaks during the pandemic, over 1 million annualized sale rate, and now we're kind of normalizing for the new construction homes sold. If you want to see what new construction builds are looking like, this is for just single family units, and we're still having this little drop that we've had since interest rates have hiked. Here's back, in the glory days from 1995, 96, and then up to the peak before the big housing bubble burst. We had a good 10-year run where we were building over 1.2 million units, and then had, another decade plus where we built almost 20 years now, where we've built under that amount. We got up to over the 1.2 million briefly during the pandemic, and now we've dropped back down. So I don't see an oversupply coming as far as new home construction goes. The real reason that new home buyers or builders are doing so well right now is just the lack of existing inventory. Right now, new homes make up 33% of the inventory that we have on the market, and traditionally that's about a 12% number. So we're almost 3 times higher ratio of new homes to existing homes that are currently for sale. And so that's why builders seem to be faring okay, even though interest rates have gone up quite a bit over the last year. We've got an annualized rate currently of about 4.28 million homes sold. This is for existing home sales. This is what the National Association of Realtors puts together. And I wanted to show kind of the history of that. This goes back to 2019 pre-pandemic. So it's definitely the lowest it's been, other than, right as the pandemic hit, we trended at a 4 million home rate, and now we're trending at about a 4.3 million home rate. This is like a record high here when we really got roaring at 6.5 million. And I found some data that goes back even further for this. You can see here the annualized rates. This was from 2009 to 2019, and here's the 4 million and the 5 million, and we kind of hovered a little bit above the 5 million rate for, let's say 2015 to 2019. And then prior to that, this is after the great crash. So 2009, we're still kind of in that. And 2010, we were in an annualized sales rate of, in the 4 to 4.5 million range. So I just kind of wanted to bring that out so that you can see new home sales, is like 680,000 units, but we typically sell, over 5 million homes. So a lot of the videos that I'm seeing and a lot of the sentiment out there is around new construction offering incentives and buy downs and all of this kind of stuff. It's still like not that much of the overall housing market. So there's deals to be had. There's certainly going to be builders that are going to go bust. But they seem to be treading water at least now, and they've definitely trimmed back new home starts. And so I'm not sure we'll see too bad of a correction in that unless we start losing jobs. Now, interest rates play a big, huge role in that. And the Fed has been talking this week, and the futures that what the market feels the Fed's lending rate is going to be has changed quite a bit since I made a video a couple of weeks ago. So right now, this is as of May 24th, we're looking at a 70% chance of the Fed's holding rates steady at the next meeting. And but there's actually almost a 30% chance now that they might raise rates. I made a video talking about how we might be through this, how the Fed's going to pause, and everybody was predicting like that we would even see rate drops before the end of the year. Here's that video. Take a quick listen here. You can see the chart here. There is now a 98.5% chance that we keep the funds rate at the 5 to 5.25. That's where we're at right now. And the market is basically predicting that there's a 98.5% chance we have zero movement. But this is where it gets interesting. If you look towards the following month, July 26th meeting, you're actually showing a 44% chance now of a reduction to the 4.75. So they were talking about a 45% chance in the July meeting of a reduction and a 98% chance of no movement. Now that is shifted to only a 70% chance of no movement, a 30% chance of a raise, and then maybe even a second raise in the July movement, 11% chance of that. But they're actually predicting, I mean, if you add these up, there's less than a 50% chance that we don't have at least one increase by the July meeting, and then maybe there's 13% chance that we cut in September. So just kind of an interesting change. A lot of this is because the Feds were doing like a press tour. There, a lot of them were speaking at different engagements, and the words that they were using were talking about, well, just because we pause in the next one doesn't mean we'll continue to pause. We really are going to be data dependent. We still believe that inflation is entrenched. We still believe we have more work to do. And so that's just kind of messed everything up. It sent the markets into a little bit of a turmoil. The Dow is negative for this week, but really what I'm concerned with is mortgage rates. If you want to take a look at like the last month of the 10-year T-bills, you can see just a steady climb from, the low like 3.4 range to 3.7. That does not bode well for 30-year fixed interest rates, which are looking like, this is all of 2022 here, but I can zoom in. This thing reset on me. I can zoom in and you can see we were kind of trending a little bit down here, and now we're back up to where the average is 7%. Now, I've shared in previous videos, if you've got good credit and a decent down payment, you're probably going to get a real rate that's about 0.5% lower than what you'll see the average is. So, take that into consideration. But, even 6.5% to 7%, we're probably going to start to see volume decrease in real estate going into the summer. That's the bad time. This is when we do a lot of the home selling. You're going to see markets that are doing better than others. But, we're going to start to see the volume slow down if we still see 7% interest rates. And then the last thing I'll say is information on offices. I've talked in previous videos about this bubble happening in commercial real estate, specifically around office buildings, because their value is tied to their occupancy or their net operating income. And their loans are not long-term loans. They're short-term. They come due every 3 to 5 to 7 years. And so if you don't have the occupancy to create an income, you don't have the value in that building. And so this is a Bloomberg article that shows some of the different trends in occupancy rates in metro areas. Now, obviously, the dotted line going up, I have Los Angeles highlighted here. The dotted line is when the pandemic hit. And so you'll get a little bit of a read of vacancy prior to the pandemic, and then vacancy shooting up, then kind of normalizing. But now we're starting to see in most of the cities, after kind of normalizing, we're seeing start to trend up. Looks like DC's doing okay. Seattle's trending up. So, you know, we haven't figured out if people are going back to work yet or not, and I don't see that that's going to happen. A lot of companies are trying to mandate it. People are protesting that, but it's also just good business practice to maybe not renew as much square footage as you had before, and then especially if we are going into a recession, maybe your staffing is going to be curbed a little bit, and so you don't want to sign any long-term leases on spots that you're not going to be using. So that's kind of what I got for you today. That's, you know, we'll have to see. I don't like to see interest rates get hiked any more than they have. I don't like to see 7% mortgages. That doesn't do well for my business. I'm still looking to buy. I say that in every video because it's true. The best time to buy real estate is yesterday. I feel like if the numbers work today, then they'll work tomorrow, especially if I can lock in an interest rate at, you know, 10-year highs. Then I should only be able to do better if rates come down and refinance out of it. But please subscribe to this if you want to see more real estate and economic data like this. And also let me know in the comments below if there's any additional information you want to see. Appreciate you guys watching. Thanks a lot. Have a good day.